As of 12:40 p.m. Eastern Time on October 29, 2025, Plug Power, ticker PLUG, is trading at $2.8735. That is a gain of 2.99% for the session, or about 8 cents, on extremely heavy volume that has already cleared 74 million shares, far outpacing its usual average. The stock has been volatile today, opening at $2.82 and surging as high as $3.05 before pulling back, but it is still holding a tight range above its intraday low of $2.70. This is not the trading of a stable utility, and it is not a normal rebound. This is the price action of a battleground. The immediate expectation, seeing a green tech name up on heavy volume, is that a new subsidy has been announced or a major buy rating has hit the wires. The reality for Plug Power is far more complex and far more precarious. The stock is currently one of the single most heavily shorted names in the entire market, and this price action reflects a daily war between long-term believers and institutions betting the company is headed for zero. The common belief, the narrative that has sustained this company for a decade, is that Plug Power is the future. It is the vertically integrated end-to-end solution for the coming green hydrogen economy. We have all heard the names: Amazon, Walmart, Home Depot. Plug provides the hydrogen-powered forklifts for their massive distribution centers. The company builds the electrolyzers that create the green hydrogen, the fueling infrastructure that dispenses it, and the fuel cells that use it. In theory, it is a perfect closed-loop ecosystem. The expectation is that as the world is forced to decarbonize, Plug will be the new standard. But the reality, the one reflected in the stock's collapse from its former highs, is that this vision has been astronomically expensive. For years, the company has been a cash-incinerating machine. This is the entire basis for the short thesis, and it is not a weak one. The core of the bear case is that Plug Power has never proven it can be profitable. It is not just about a lack of net income. The company has struggled for years with deeply negative gross margins. This means that, for a long time, it was effectively losing ground on every single unit it sold, even before accounting for research, marketing, or corporate salaries. While those margins have improved, moving from a staggering negative 92% last year to a still problematic negative 31% in the second quarter, the company is still burning cash at an alarming rate. It posted an operating cash outflow of nearly $300 million in the first 6 months of 2025 alone. This is why the short sellers are here. As of the most recent data from mid-October, a staggering 30.05% of Plug Power's entire float is sold short. That is 331 million shares betting against the company. The days to cover, a metric that estimates how long it would take all shorts to buy back their shares, sits at 3.39 based on recent volume. This is the setup for the mother of all short squeezes that many retail investors have been anticipating for months. But this is where we must separate expectation from reality. If you are an investor, you can find this short interest data on most major financial platforms, from NASDAQ to FinViz. But the number you must check next is the borrow fee. This is the interest rate short sellers must pay to borrow the shares to sell. For a stock with 30% short interest and a cult-like following, the expectation would be a sky-high borrow rate, perhaps 50%, 100%, or even higher, as we've seen in other meme stocks. The reality for Plug Power today, the borrow fee is a minuscule 0.58%. This is a critical insight. It means that despite the massive short position, the shares are not hard to borrow. This implies the short position is not a frantic, panicked, retail-driven bet. It is a large, structural, and comfortable position held by institutions that are not afraid of a squeeze. They are making a long-term, fundamental bet that the company's cash burn and constant need for share dilution will eventually render it insolvent. This is not just theory. The off-exchange data supports this heavy action. Just yesterday, October 28th, the FINRA short volume ratio was 51.13%, meaning a huge portion of the trading is happening in dark pools and is dominated by short-selling activity. Furthermore, looking at the failed to deliver data from the SEC, we saw significant spikes in September, with one day, September 24th, showing over 4.7 million shares failing to deliver. This is the kind of data that fuels the retail argument of manipulation, suggesting that shares are being sold that do not even exist. While that is a serious allegation, the simpler explanation is that the institutional short case is deep, liquid, and not in any immediate danger. This has created one of the most extreme analyst divides on Wall Street. On one side, you have H.C. Wainwright, which maintains a buy rating and a $7 price target, believing the company is at an inflection point. On the other side, you have Citigroup's Vikram Bagri, who recently reiterated his sell rating with a price target of just 75 cents. His thesis is simple: the company is not economically viable. It will continue to burn cash, and it will have to dilute existing shareholders to oblivion just to keep the lights on. What's your take on that analyst divide? Is H.C. Wainwright right with their $7 target, or is Citi's 75-cent call the more likely outcome? That dilution is not a threat. It is an ongoing reality. On October 8th, the company announced it had raised $370 million through a warrant inducement transaction. For the bulls, this is good news. It's $370 million in cash to fund operations, pushing back the insolvency clock. For the bears, it's just another hit of the dilution drug, adding more shares to the float and proving their thesis that the company can't fund itself. But the entire narrative for Plug Power was just reset. On October 7th, the company made its most significant announcement in years. Andy Marsh, the longtime CEO who has been the face of the company for a decade, is being succeeded by Jose Luis Crespo. This is without a doubt the most important catalyst for the stock right now. The market knows the old playbook: massive revenue growth, visionary announcements, and devastating cash burn. A new CEO is a signal that the board's patience for that playbook has run out. Crespo's mandate will not be to sign visionary deals. It will be to execute Project Quantum Leap, the company's internal restructuring plan. The singular goal of this plan is to achieve gross margin neutrality by the end of this year and positive margins in 2026. If he fails, the 75-cent price target looks plausible. If he succeeds, the shorts are in serious trouble. And to be fair to the bulls, the company is still executing on new business, even in the midst of this financial turmoil. On October 23rd, Plug announced a new partnership with Edgewood Renewables to build a facility in Nevada that will produce sustainable aviation fuel. That same day, it announced an expansion of its solutions with a major customer, Floor & Decor. On October 21st, it proved its European hydrogen supply capabilities, and on October 1st, it delivered its first electrolyzer for a 100-megawatt green hydrogen project with Galp. The business is not dead. The question is whether it can grow fast enough to escape its own balance sheet. So this is the landscape for Plug Power. It is far more than a simple green energy bet. It is a high-stakes financial drama. You have a new CEO tasked with an impossible turnaround. You have a massive, entrenched 30% short position that is so comfortable it's paying almost nothing to be there.
You have a stark analyst war between $7.75, and you have a company that is simultaneously signing major new economy deals while funding itself through old economy dilution. The expectation is that this is a high-growth tech stock. The reality is that it is a distressed company fighting for its life, and its survival hinges entirely on the new management's ability to achieve profitability before the capital markets close. For any investor in this name, the only thing that matters is the next earnings report, expected in mid-November. This will be the first conference call with the new CEO. We must hear a clear, precise, and believable path to positive gross margins. Any vagueness, any return to the visionary talk of the past will likely be punished severely. Comment below with your average cost basis on Plug Power.